Hey guys, just want to make this video about market orders versus limit orders, as well as stop losses and how exactly you guys should do them. I want to talk about this topic because I thought it was pretty common knowledge for any traders, after they do a little bit of experience or get a little bit of experience with virtual trading. But I saw this wasn't the case. I just came back from a dinner with a couple of friends who have just recently started getting into trading, and they made this mistake, and once I did a bit more research, I saw that it was a common mistake. So hopefully you guys can watch this before you make the same mistake yourselves, saving you potentially hundreds of dollars. So let me just get right into it. So as you probably know, there's two types of orders that you can do whenever you're trying to buy stocks. You can do a limit order and a market order, and I've probably heard that, or you've probably heard actually, that you want to place limit orders, and because that allows you to control your entry, it allows you to buy all your shares at a certain price that you determine. So you have more control, because especially when we're dealing with these penny stocks, you have to understand that there is the chance that there is an imbalance in the buys and sell orders. And what I mean by that is, I hope all of you guys have been trading with level 2. If not, see my video about how to get free level 2 and why you can need it. But sometimes you see with these shares, with these OTC stocks or pink sheet stocks, and even these small NASDAQ or New York Stock Exchange stocks, you can see like the price jumps in a weird fashion. Will be like 125. The orders will be executing at 125, 125, and then it jumps to like 135 for a second, and then it jumps back down to 130, and then back to 125, and it goes back to normal. But these are caused because of sell order imbalances. Now, this is this is funny. It's the Charles Schwab website, but they have a typo here. It's pretty professional, but anyways, in this they are talking about stop losses, which I'm going to get to in a second. But I just want to make sure that when you guys are trading these stocks, these penny stocks, even if there's a whole bunch of volume, even if there's millions of shares being traded, make sure that you only place a limit order. You want to get your shares in at a certain amount, because you need to go in with the plan and stick with that plan. And the market order can be executed at too, it's too risky, it's too volatile. You might get, even if there's, like I said with that previous example, even if the stock is trading on 125, if you put in a market order, these ECNs and the order executions are choppy and shaky, and you might get it at a weird price. So you don't want to put yourself within that risk. Do a limit order, protect yourself. Now let's move on to stop losses. I always say, and I always believe, whenever you go into a trade, you need to have a stop loss in place. Where are you going to sell? If the trade is going against you, personally, sometimes when I'm following my devil catalyst rule, if the stock, the second it goes into red, I sell. So, I only lose maybe a cent a share, if that. But sometimes, you will need to allow for a little wiggle room. Sometimes the market is just correcting itself, but you need to have a mental stop loss in place. The reason I say mental is because a lot of brokerages and a lot of broker accounts, they don't have stop limit orders. So the issue is, if you place a stop loss to sell, say you want to sell $2, okay, which is good because that's a good round number. If the stock goes lower than $2, it's probably, a lot of people are probably going to sell. So $2 or maybe $1.99 you want to sell it up, because $2 is going to be where the support is, and so if the stock ever breaks the support, it's going to plummet. So you want to get all out at $1.99. That's what I would do. But you don't want to set an actual stop loss there. It has to be a mental thing, and you just have to be able to be quick in your executions so that you can place the stop loss, the sell or limit order at $1.99. So if your brokerage allows for stop limit orders, then you're set and you don't have to worry. But let me tell you the issue about just a general stop loss, and this is kind of what they're referring to here. I don't use stop loss orders. They don't work because my stop was executed at a much lower price. And again, this is talking about you setting a stop loss for $2, right? or even $1.99. But what happens though is the stop loss is going to trigger once it's like an alert. It triggers once a certain event happens. So once the stock is being traded at 199, the event goes off. But then at that second it places an order, a sell order, but it places a sell market order. And the problem with that is, again, what I was alluding to previously, you are then exposed to the imbalances of the market, you know, the imperfect market of these OTCs and these pink sheets. You know, these executions end up being very shaky and choppy, and you don't want to expose yourself to that. So you need to, if you pick a stop loss, you need to make sure that it's a limit order, or you just need to have a mental stop loss that you don't break, and as soon as the stock hits that point, you need to be quick in your execution to sell and liquidate your position.